Welcome to PhillipCapital Experts Talk. My name is Lin Sin from Unit Trust Research. Today we are privileged to have Mr. Geoffrey Lunt, a senior product specialist responsible for Asian fixed income products from HSBC Global Asset Management, to take us through the investment prospect of Asian fixed income. A brief background of Mr. Geoffrey. Mr. Geoffrey has been working in the industry since 1992. Prior to joining HSBC in 2003, Geoffrey worked as a fund manager at Investec Asset Management, where he managed bond funds for insurance companies, building societies, and UK local authorities. Previously, he was the director of Plough Court Fund Management. He holds a degree in Classics from the University of London. Thank you, Mr. Geoffrey, for taking the time to attend this interview with us.
My pleasure.
Let's start off with Japan, shall we? With inflation imminently reached Bank of Japan's target rate of 2% upon the April's tax hike, we see that the current bond market has not priced in the inflation expectation, as nominal yields for 10-year yield still stood at about 0.6%. Further to that, with an ultra-loose monetary policy suppressing yen and interest rate, how should credit investors position themselves?
Well, I think that the story behind the JGB market and for the credit market is only loosely, in fact, connected. So in terms of what our views might be on JGBs, I think you have to be a little bit careful interpreting the inflation and growth data into what longer term interest rates should be in Japan, not least because of the extremely extensive quantitative easing program, which of course is bound to depress bond yields. On a technical issue on the inflation front, a VAT hike or a sales tax hike is not necessarily going to be something that is an enduring upwards pressure on inflation, and in fact might restrict some consumption. So from that point of view, I don't think that it's necessarily the case that bond yields don't reflect the position of the economy at the moment. And as I say, it's distorted anyway by the quantitative easing process. So you've seen 10-year yields fall to about 60 basis points, I think. So JGBs have actually rallied over the course so far of this year. And I wouldn't encourage investors to think about being ultra bearish of that asset class at the moment, given those significant pressures on either side of the supply and demand balance. In terms of your question about credit, I think that in terms of the overall global credit markets, then the liquidity that is going to continue to come into the Japanese market is probably broadly positive. And so from that point of view, I don't think that it's going to cause a significant volatility in credit spreads throughout the world.
Governor Haruhiko Kuroda has indicated on April 23rd that the central bank won't buy bonds just to keep down debt servicing costs after achieving its inflation goal. In other words, Bank of Japan has started to manage markets' expectation on interest rate hike with inflation as benchmark. In your view, what are the risks when Bank of Japan starts to taper its bond purchasing program, and how should credit investors adjust themselves?
Well, again, I think we're in the realms of the hypothetical here. I think that it's a healthy thing for central bankers or officials of government organizations to encourage investors not to think about things being a one-way ride, and therefore introducing the concept of two-way volatility into markets is always quite helpful in that sense. So although you've had comments like that, there's not the prospect of significant rate hikes by the Bank of Japan, I think, is something that is too far in the future for it to really be thought of as something that can really withdraw liquidity from the global system to an extent that investors globally in credit should take it into account. As I say, I think that in the near term, so we're talking about in the 3 to 6 to 12 month horizon, I don't think that this is something that investors in credit markets should necessarily see as a negative impact, and it will probably remain a mild positive to credit spreads as time goes on.
Despite hopeful emergence from deflation, according to IMF, the government's obligation will grow to 242% of GDP by end of this year. Could you share your views on the massive public debt, which the government may be under pressure when interest rates rise?
Well, I guess the broad answer is no, because I think that having anything new to say about the massive amount of debt that the Japanese government bonds represent compared to Japanese GDP is not a new subject. So I'm not sure I have anything very new to say about that, apart from, of course, that it probably is sustainable, given the fact that it's a very domestically driven market, and one where domestic institutions are required to hold significant amounts of government debt, and it remains a very significant part of retail investors' savings. And so from that point of view, we believe that that a 240% debt to GDP burden in very many other countries could be a catastrophic situation. In Japan, it's not going to have the same impact. And so from that point of view, you can possibly look at it more in terms of a longer term issue which may cause a problem somewhere down the line, but we're talking many years away. And on the top of that, of course, you have the other side of the balance sheet, in terms of the fact that the QE program means that an awful lot of JGBs have just ended up on the central bank's balance sheet. Who knows how that could progress, how that situation could progress, both for the Bank of Japan, the Fed, the ECB. The one thing that Japan does have, of course, in its favour, which the Eurozone did not have, is flexibility and control over its own currency. So from that point of view, a very heavy debt burden is much less troublesome than it would be for certain of the Eurozone countries, for instance.
Let's move on to China. Against the negative headlines and amid credit tightening in China, what is your view on China's fixed income market?
Well, the Chinese fixed income markets, as you know, are split into two. So you have an onshore market, which is actually one of the biggest bond markets in the world. And you have an offshore market, which is much smaller, but is available to global investors. So the onshore, take the onshore market first. It is mainly a government and government-related market. So 80% of the market is government, or government-related in that sense. I mean policy banks and institutions that have the direct obligation of the government, but also, of course, state-owned banks, state-owned enterprises, and only quite a small amount of the market is what we would describe as corporate debt, if you like. Now, in that sense, there has been an attempt to introduce more market forces into the credit pricing mechanism. And from that point of view, we have felt for a long time that onshore credit, in what we would call, perhaps in other markets, corporate bonds, that spreads have been too narrow. Because when you have the situation where the government will stand behind a corporate bond issuance, well, why would you attach a great risk to investing in that? I think that has to change, and also it is changing in the light of the first onshore bond defaults. And so from that situation, we do think that further down the credit curve in China, that credit is still too expensive. So we expect further spread widening in the onshore market, in the credit market, and the government market seems fairly priced to us in terms of the future prospects and the likely evolution of interest rates in the economy. So credit spreads to be wider, government bonds to remain stable. Moving to the offshore market, this is very different because the influences on that are, by definition, all from non-mainland China. And so it's a lot to do with supply and demand within the market, and it's also to do with the prevailing interest rates which affect the investors, which will be more aligned to the G7 sort of rates complex, which of course is much lower. And that's why offshore bond yields are much lower than those in the onshore. Now, we believe that this credit is of a very high quality, but not only that, very high credit quality on average. There are obviously tail risks to that. But from that point of view, we think that is a good or fairly priced credit market. But of course, there's very low duration in the offshore market as well. Most of the corporate issuance is only 3 years. There is some a little bit longer, 5, and even some a little longer than that. But generally speaking, it's very low duration. That means that the credit market's not very volatile. It also means that as long as your bond doesn't default, you're going to get your money back quite quickly. And so from that point of view, the offshore market does seem to be stable, and even in the context of other concerns about China, has remained remarkably stable, actually, particularly within the emerging markets complex.
With renminbi continue to depreciate, would you agree that investors can no longer speculate on rising yuan via the dim sum bonds or yuan-denominated bonds issued outside the Chinese mainland?
Well, let me make this absolutely clear, and I think this is a very important point. If you are buying dim sum bonds because you believe that the renminbi is a one-way bet against the US dollar, you should sell them now, because that isn't what this market is about. If, however, you're willing to take a longer-term view that the positive currency fundamentals of the renminbi against the US dollar mean that you will get a secular appreciation over time, and that you think that the underlying credit is sound and will give you a decent yield, then absolutely I think that this remains a very attractive market. I would just contend with one point that you made, the continued depreciation of the renminbi. The renminbi has actually been very stable for the last few weeks. And so from that point, and not very volatile at all. And so from that point of view, I think that we're already seeing a stabilization there. But one of the reasons that this has happened, this period of weakness in the renminbi, has happened because the People's Bank of China is absolutely determined to say to everyone, whether they be onshore or offshore investors, that there will be more two-way volatility in the currency. And not only that this is part of a wider project, which is the internationalization of the currency. And from that point of view, it has to have more two-way volatility over time. So don't expect for there just to be this very, very gradual, permanent appreciation of the renminbi. Those days have gone now.
The high-yield China property bonds were once an investment darling. However, with the current rate alert in property market, the recent default by Zhejiang Xinran Real Estate stoked fear of more defaults to come. Do you think that the property sector bonds remains a rational bet amid turbulence?
It's interesting that you describe them as the darling of the market. I'm not sure that they were ever that, and I'm not sure that they're not quite close to that now, because what you do get from Chinese property bonds is good value in terms of the fundamentals of the underlying companies compared to the price that they're trading at. And so from that point of view, I think selectively there are good deals to be had in the offshore property bond market. Now, there's something important we need to say here about the difference between onshore bond market and offshore bond market, because all offshore issuers, by definition, are those which have alternative sources of funding. It would not be possible for an onshore entity to go to the offshore market because they can't raise money onshore. And therefore they tend to be the larger companies. They're not necessarily the most creditworthy, but they do have good underlying fundamentals and scale within the market. It's our job to be discriminating between the good ones and the bad ones. And so you can't make a broad brush comment about the sector as a whole. As it happens, we're being very selective at the moment because we do see that parts of the property market in China are suffering some stress. We don't believe that this will be widespread or enduring, but of course from time to time there will be this volatility. So we're concentrating at the moment in the very high quality end of that spectrum, and therefore we may give up a little bit of yield in order to protect ourselves and our investors from any default risk. As it happens, we don't expect there to be any defaults in the offshore market, but there are likely to be more on the onshore market because it is much larger and because the quality of the credit generally is less good and the investor protection is less good.
Could you share with us a near-term overview on Asian credit market, including the bond yield, hence bond price?
Sure. Well, I think that at the moment what you're seeing is terrific value in Asia compared to other parts of the world. And that's really because there has been a significant rally in Europe especially, but also in US markets. And that has especially been the case in the high yielding area of the credit markets. Asian high yield remains very wide. The spread on the JP Morgan Asia Credit Index in the high yield space is over 500 basis points, whereas in the US it's around 300, and in Europe it's only around 200. So from that point of view, you get very good relative value across the geographies. Therefore, if you don't expect significant defaults, which we don't, and indeed Moody's in the last couple of days have come out expecting continued very low default rates in Asia, then this really is a very good time to invest in Asian credit. And the beauty of fixed income markets, of course, is that you don't need spreads to tighten. As long as you hold the bonds, they will continue to give you these very good levels of income carry. And so from that point of view, I think that this is a very good time to invest in Asian credit, particularly on a relative value basis.
In light with the above development, what are the investment opportunities which investors can look into? Within Asia Pacific region, which are the countries or sectors you are most optimistic on? Well,
let's take a very recent and topical event of what's been happening in India and talk a little bit about the Indian fixed income markets. Because it was a market that did not perform well in 2013 because of the depreciation of the currency, and really India becoming caught in a bit of a vicious spiral because their current account deficit meant that the currency was depreciating, which then led to inflationary forces, but the central bank wasn't willing to put up interest rates, and the whole thing became a vicious circle. Now that vicious circle has been stopped dead in its tracks. First by the activities of the central bank governor, who was new to his post, immediately put up interest rates, immediately put in place plans for an inflation targeting regime in India, and you saw a stabilization of the currency and also a stabilization of bond yields at a high level. So you get good yield and carry from your bonds, but also you now have a stable currency as well. Of course, with the landslide victory for the BJP and the results that we saw last week from the election, this is all very encouraging. Investors shouldn't expect a massive appreciation in the rupee from here. And the reason for that is just that the central bank is leaning against that movement. They don't feel that a much stronger currency is helpful, and therefore they're buying dollars as the rupee strengthens in order to rebuild their foreign exchange reserves. That's good news for the long term. In terms of the short term, we see a stable to marginally stronger currency plus stable bond yields. In the medium to long term, we see a secular decline in bond yields as inflation becomes under control, and also a positive view on the currency. So that's a niche opportunity within the Asian fixed income markets.
Having said that, would you prefer local currency bonds or hard currency bonds?
Well, I think that at the moment we have we would rank them pari passu in terms of attractiveness, because and also it's important to differentiate between the different local currency markets, because they go all the way from AAA Singapore and Hong Kong all the way down to close to high yield markets like Indonesia, Philippines and India. So I don't think it's appropriate anymore to talk about Asian local currency markets as if it's one market. And I would be selective about exposure there. And maybe you might have negative views on a market like Hong Kong, for instance, which is a very low yielding market in terms of the sovereign space. So we see selective value in the local currency market, but also selective value in the credit market as well. So I'm sorry if that's not a very satisfactory definitive answer, but I think that both markets are very attractive in terms of their valuations against other parts of the world.
In view of an interest rate hike environment, how should investors position to mitigate further downward pressure from the sell-off in fixed income?
Well, that's an interesting thing, because what you've had in fact in 2014 is not a further sell-off. You've seen something of a reversal in fixed income markets, because US Treasury yields have declined, implying higher prices, and credit spreads have been stable to tighter. And so, and some of the peripheral emerging markets have also rallied strongly. So I'd slightly argue with the premise of the question. But nevertheless, if we do have rising interest rates at some point, and I think the consensus is that it won't be until 2015 at the very earliest, then there are certain ways that you can protect yourself. And one of those ways is to go for the higher spread products, because one has to assume that in an environment of low inflation, if interest rates are going up, that implies a very positive economic environment. So that should keep spreads at least stable to tighter. And from that point of view, a rise in the core yields and the core treasury yields should be compensated for by the greater carry and perhaps a narrowing of spread. So I would look at the higher yielding local Asian markets, again, such as India and Indonesia, but also the higher yielding end of the credit spectrum as well.
Thank you, Mr. Geoffrey, for sharing your insights with us here today. For more information on unit trust, please log on to www.eunittrust.com.sg or talk to us at any Phillip Securities branches. Thank you.